Good morning and welcome to 3 Minutes on Markets and Money. I'm your host, Lance Roberts, talking a little bit about Friday's rally and an update from this weekend's newsletter, which is on the website now, talking about risk ranges and kind of where we are currently within this rally. Over the course of the last couple of weeks and really the last 15 days, the market's had a very, very sharp rally off of these lows. Now, this is what we said a few weeks ago, is that the crash would lead to a rally where everybody get very excited and that the bull market was back, the bear market was over. That is certainly not the case, particularly with the level of economic devastation that is now coming down the road. We're going to see some real impacts to earnings for corporations. And again, since stock futures and stock prices price in future cash flow and growth, those numbers are not going to be good. Even if they're looking past 2020 earnings, 2021 earnings, not good by a long shot. But here's the important thing. The market is continuing to build right now a very defined range of trading, and that range is getting narrower and narrower as the market goes up. This is typical of a bull market advance, and what you're seeing here is this reflexive rally in the market that is getting more and more narrow as we go. In fact, if we look at participants in the market, the top 5 biggest market cap stocks have made up really the bulk of this rally here. Small cap, mid cap have really not participated. The number of stocks that are above 50-day and 200-day moving averages still very, very low. Not really seeing the type of participation that says this is a real lasting bull market rally here. Again, just a nice reflexive rally, but there is upside of about 4% till we get to the top of the 200-day moving average. That's likely going to be the top of this rally. So we've got about 4% here to the upside. Could be as much as 7% to the upside if everything kind of just goes perfectly here. To the downside, if we break below this rising kind of trend line, which we may actually do over the next few days this week, as we see some of this economic data come in, our downside risk runs about 4% again to the bottom of the first support, about 12% to the bottom of the next support, and of course the March 23rd lows are 20% lower than they are today. So again, there's a lot of downside risk here to the markets that really outweigh the potential of the upside run that's available. So from a market perspective and as a portfolio manager, this is where you start looking at maybe taking some money off the table, rebalancing risk, and paying attention to what you have going on within your portfolio. Again, we're very early in this game of the markets. The markets are not going to V-shaped recovery. We're not going back to all-time highs anytime soon. Look, I know everything is possible because of the Federal Reserve. They're putting in all kinds of money. Yes, this could be entirely wrong and markets just rocket to all-time highs. History says that's even likely not to be the case, even with the Federal Reserve in place. Doesn't mean we're going to crash to all-time lows, but there is more risk to the downside at this point than upside opportunities. So again, just good portfolio management says take a little money off the table, reduce your risk here a bit, and particularly pay attention that our money flow indicator is getting very, very close to turning lower. And this has been a very good indicator about pointing to tops in the markets previously. Sometimes they're small declines, sometimes they're big declines. But again, this money flow indicator suggests that we're about to see another downturn in the markets. Again, that's why you want to take some profits here, have some more cash. Because look, downturns are not a bad thing. They provide you an opportunity to buy stuff that you wanted to buy back over here. You're going to have another opportunity to buy it cheaper in the future. So again, pay attention to what's going on with your money. Pay attention to risk. Really kind of avoid the hype of the markets and pay attention to what's really happening. Because again, as investors, what we invest in is valuations, forward cash flows, future earnings. That's what we're betting on, and that's what we're buying. So remember, it's more important to understand what you're buying and know what you're buying rather than guessing at what it might be. Get by the website, realinvestmentadvice.com. Our newsletter's on the website now, realinvestmentadvice.com. If you have any questions or comments, let me know as well. Just simply click the Ask a Question button, realinvestmentadvice.com. That's 3 Minutes on Markets and Money. We'll see you next time.